All right, guys, welcome to our second video of our series on individual stocks and ETFs. In this video, we're gonna go over 4 things. How do stocks go up and down in the short run and long run? Growth versus value stocks. What is risk? Very important you understand my different opinion of risk. And 4, how an individual like you can learn to beat the market over long periods of time. So first off, Mo, give me the famous quote about why stocks go up and down in the short run versus long run.
In the short run, stocks are a voting machine, meaning that you, whomever, is voting and just sending the stock up or down. And in the long run, it's a weighing machine. What's behind the company?
Yeah, so what's the fundamentals, et cetera. As a channel, we focus on the fundamentals of a business. How much money they make, how much revenue they make, how much cash flow, how good is their balance sheet. And the more videos you watch, you'll get a better understanding of those things. But in the short run, none of that stuff matters.
Yep.
At any given time, it's whatever's most popular at the time. If suddenly you have 100 million people all buying one stock, that stock is gonna skyrocket. It doesn't matter what happens.
A perfect example of that, if you paid attention or heard about the GameStop saga, it was that. There were people on a forum that all got together and said, we are going to buy this. Not caring that GameStop was about to go bankrupt. It was just that they were all going to buy that and everyone was on board.
Every major bubble in history, whether it's stocks, real estate, any other asset, basically takes a very basic, good premise and exaggerates it because the masses go towards it. It's a very common thing in investing. Basically, where the masses are, you should be very hesitant because we believe as a channel that it's possible to overpay for a good thing. Usually, these ideas make a lot of sense. Look at the AI bubble lately.
Yeah.
AI will probably change the world. Look at the internet bubble in 2000. Look at real estate. These are very foundational. The internet did change the world, but there's a reason why 98% of those internet companies went to zero. It's because in the short run, stocks are a voting machine, but in the long run, when you look at those companies, what fundamentally mattered, their revenue, their profit, and their balance sheets is what drove it. Let me show you some examples. Let's look at one of the poster children of the tech boom, Cisco Systems. This was a company that they thought was gonna be the first trillion-dollar company, hit $500 billion market cap back in 2000. Guys, its all-time high was $82 back on March 27th, 2000, over 23 years ago, and it has not surpassed that since. And in that time, you might sit there and say, wait a second, the company's probably done crappy. Well, let's go look. This last year, it brought in $55 billion in revenue. In 2000, it brought in $19 billion in revenue. It went from $19 billion in revenue to $55 billion in revenue, 3 times more. Okay, what about profit? Well, in 2000, it made $3 billion in profit. Last year, it made $11 billion in profit, almost 4 times more, but the stock has not rebounded since. It has not been its high. If I told you back in 2000, when the stock was at $82 a share, if I'd said to you, hey, 23 years from now, they're gonna have 3 times more revenue and 4 times more profit, where would you have guessed the stock price to go? You'd have been like, oh, it's going this way. And it's gone down. Why? Because people overpaid right here. Now you might sit there and say, well, that's one example. No, there are many, many examples. Even companies that are selling for more money today than they were back then, like Microsoft and Apple, the stock price did not grow as much as the fundamentals. It's still possible to overpay and do okay, but Microsoft, for example, is worth 5 times more than it was in 2000. But it's only a 5.5, 6% return. Yet the company is making a ton more money, way more than that. It has grown its profit way more than that in the last 23 years. And that's the key.
Yep.
All right. Now, Mo, the next thing we need to talk about is growth versus value. Right. Now, you and I, as you're smiling for a reason. Why are you smiling?
Because I don't like that comparison.
Right. Why is that?
Because most every company that I look at is in some type of growth phase.
Yeah.
Growth is not exclusive to growing 500% per year.
Right. So, guys, value investing is basically saying, I want to take a future stream of cash flow, decide what it's worth to me, and buy it for a discount. And guess what? Growth companies have a future stream of cash flow, and they grow faster. But you can get a discount on that. If I have 2 companies that are exactly the same today, balance sheet's the same, in the same industry, but one grows 5% a year and one grows 20% a year, which one should I pay more for?
20%.
Absolutely. However, what happens in the market is people say 20% growth, I'm gonna ignore the 5% one and only put money in the 20% growth company, and the stock price gets so high that it can't justify even that 20% growth rate in the company. Growth is an extremely important part of value. In fact, in our stock analyzer tool, the very first line that you have to input is revenue growth. If it wasn't important to us, why would we put it there? That doesn't make any sense. So to us, we always snicker when we hear people say, oh, are you a growth investor or a value investor? We just always go, yes.
Or when you hear them on television say, it's time to switch from growth to value.
A good growth investor understands value.
Yes.
A good value investor understands growth. That's it.
Very simple.
We don't think there's a difference. We just think there's a thing called an investor. That's it. And an investor is always trying to buy a future stream of cash flow for less money today than it's probably worth. That is purely it. Trying to buy a dollar for less than a dollar. It's simple, but not easy. Why? Because what we talked about before with our example of Cisco. Because it is hard to ignore the market when this is happening. It's hard to ignore Cisco when this is happening. And you see that a lot today in a lot of other companies. And stocks can be irrational longer than you can be solvent. This can last a long, long time. For us, it's been going on for many, many years. This period right here was 96 to 2000. It's 4 years of just watching the stock go up and up and up and up and up. And then finally, one day, valuations do matter. And this is the risk involved. But speaking of risk, let's get to the next topic. Mo, I don't know if we have this conversation a lot, but what do you consider risk to be? Because I'll tell you what my definition of risk is, and a lot of people in history have disagreed with me, but risk is purely the price you pay. So let me ask this question. This iPhone right here, what's this thing worth?
Probably $1,200.
Okay. If you paid $12,000 for it or $12 for it, which one's riskier?
$12,000.
Right. The thing is still the same.
Because I overpaid for it.
That's it. Everything in risk can be adjusted by the price. So whenever I hear people say that's a risky asset, I laugh. I go, well, if I pay a cheap enough price, it's not a risky asset. Let's use an example for Bitcoin. I think Bitcoin's a bunch of crap. But if somebody gave me all the Bitcoin in the world for $0, I would take it. I'd be like, okay, well, that's fine. I have zero risk.
There's no risk.
But if somebody said to me, hey, buy all the Bitcoin from me at current market price, I'm like, too much risk. It's the exact same asset. Your home, for example. If you own a home, if whatever asset you own, the most valuable thing you own, multiply the value price by 20 and divide it by 20. Which one's riskier?
Multiplied by 20.
Multiply by 20. That's it. Risk is purely a factor of what you've paid. And sometimes the price needs to be negative. Let me give you a crazy example. Let's say you have a home that's worth, in a normal neighborhood, worth $500,000. Wonderful. And all of a sudden, you find out that there is a volcano underneath that house that will spew out, and it'll cost $5 million to remove that volcano, or it'll destroy the world. What's that house now worth? Negative $4.5 million. It can be a negative number. So you would tell me, Paul, I need to give you $4.5 million just for you to break even. That might sound crazy, but value, it can be negative. And you can sit there. I've made offers on properties before where I said to them, hey, if you want me to buy this property, you got to give me a check because there's way more work I have to do to the property to even get it to a point where it's worth something to me. That is the true understanding of value. I have paid full price on 100 unit properties in my career. I'm about ready to offer full price on a 180 unit property locally. Why? Because I think the value is greater. I've also sat there and have people tell me, hey, Paul, this property or this stock is down 80%. Would you buy it? No, because I don't think it's worth it. Even though the price was down 80%, it still wasn't at a value that made sense to me. If you can understand the difference between price and value, you will do wonderful.
Going back to a home. Say you have a home for $500,000 and you list it for $5 million. Just because you reduce it to $2.5 million doesn't mean that it's 50% off, sure, off of what you were offering, but it's still
doesn't make
$2
it worth
million
it.
Over ask.
Absolutely. $2 million over value.
$2 million over value, I'm sorry.
So there's an old saying, and it's botched a little bit, but what it's become is a fool knows the price of everything and the value of nothing. Kind of saying, hey, we always focus so much on price. And trust me, I fall for this in many ways. But when I'm able to offer full price or even able to, on a property or able to pay the price of a stock, I own 12 companies right now, even though the market is massively overvalued. Why? Because I think their long-term potential is better. Which leads us to our final point. Mo, how can an individual beat the market over long periods of time?
You need to, A, go into ETFs. Or B, you need to be able to buy companies for less than they're worth and get that valued return over time.
Right. Now,
it's hard to do.
It's easier said than done. The hardest part is being the person who ignores this and everybody calls you stupid. And then when this crash happens and everybody thinks this stock is worth nothing, you're buying down here.
Basically, you have to have the emotion.
You have to have the emotion. That's why when I hear people say like, oh, that person's smart, they're going to do well. That's why all the Harvard MBAs, the mutual fund guys, all those guys who have massive research teams, you have a major advantage of them. You don't have career risks. You can sit there and do nothing. You can sit there. In fact, I've programmed myself after 15 or 20 years without the guidance of a channel like this. So imagine how fast you can do it. I've programmed myself now that the second I hear somebody recommend a stock to me, I immediately think, that's garbage. And when somebody says to me, I'm avoiding that like the plague, I go, let's talk about that one. Because to beat the stock, to beat the market over long periods of time, a couple of things need to happen. In short periods of time, 3-4 years, you got to trail the market. There is a stat of mutual funds that do beat the market. In mutual funds that do beat the market in a 10-year period, at least 1 out of those 10 years, they will be in the worst performing 10% of their mutual fund category. The worst performing. That's a hard pill to swallow when you're making fees and having people exit you because of that. Peter Lynch got amazing returns at Magellan Fund, but you know what he says to people? He goes, the average investor in my funds did not make a lot of money. Why? Because they invested at the wrong times. When our fund wasn't performing well, people were moving money. But that was the time you should have been buying, or we should have been buying more stock. Look at ARK Investments with Kathy Wood, my virtual girlfriend. First off, the average investor is down 40 or 50%, even though her fund in the last 5 years is up about 20% total. But at one point, it was up 400 or 500% because everybody bought when it was too high. They were chasing returns. So in order to beat the market, you need to pick individual stocks that are mispriced, but more importantly, you need to have the emotional ability that when people tell you your stocks suck, that you buy more and you stick with them. But guess what? You have to be right still. Right? But good news is you have to be right 100% of the time. A successful value investor, you can beat the market being right 40 or 50% of the time. As long as the 40 or 50% you're right on, you let them run and run and run.
And it's funny, if you start reading some books, there's a lot of investors that are extremely successful at the end of their career. They're like, I had 2, 3, 4 good wins over my life and everything else was kind of okay. I had, of course, losses, but 2, 3, 4 big wins over your career is going to change everything for you. So we have the basics of the stock market down. Our goal is to get you to the point in this series where you can go and buy your own stock or index fund. For those of you that are ready at this point to go and buy an individual stock, click this video right here. For those of you that are not there just yet, and you might not get there, and that's perfectly fine, ETF investing is a great thing. If you want that more passive way of your investing career, click this ETF video right here. But for everybody out there, I suggest that you go watch both of them. Let's go to the next one.